Good afternoon and welcome to the New York Stock Exchange. My name is Kenny Polcari, and today I'm joined by Glenn Bierman, who's the CEO and co-founder of Tycon Partners. Now, so you understand, Tycon Partners is a firm that specializes in growth capital and IPOs and Reg A's and providing pathways to the public markets. Welcome to the New York Stock Exchange. Thank you for joining me here today.
Thank you,
So
Kenny.
let's just talk a little bit. Tell us a little bit about Tycon Partners and what you do.
Tycon Partners specializes in assisting early stage growth companies. And what we mean by early stage is they've had to have experienced at least $1 million in revenue in the prior year and have experienced substantial growth in the following year. So they're trending the right way. And most importantly, they must have good management and a compelling story behind their company.
I think a compelling story is always important, right? I mean, investors are always looking for the next big idea. So if it's not compelling, it's not interesting.
That's true, but also investors are very cautious. And we always hear from investors that they'd rather invest in great management and a mediocre story than a great story and mediocre management. So you have to have a combination of both.
Definitely have a combination. I think, listen, I think that's very clear, right? And I think it's also, there's a lot of these companies that are out there looking to generate growth capital. So just walk me through the process. Tell me how the process works at Tycon.
So our process is we first do our own review of a company. We're focused on working with quality companies that have that right ingredients, as opposed to just taking on a lot of clients. So we've gone through 30 companies before we found one that had the right ingredients. So that process is our analysis. We're not just looking for a company to engage us and pay us. We want to make sure we can get them to the end goal. Typically that end goal is a public listing, but they always need a bridge to get there.
Right. But listen, out of those 30 companies, we're not making a qualification on what those companies were, what the managers were. It just, they weren't ready. Some of them were not ready to take this next step. And I think that's really key when you talk about the types of companies and who you're looking for, who you're looking to help, and who's ready actually for the IPO process. Tell us a little bit about the IPO process and what that's like at Tycon.
So before we go there, I just want to talk about something additional that's really important. What's happened in the change in the financial industry is by adding Reg A+, Reg CF for crowdfunding. There's been a misnomer with a lot of companies. We get a lot of calls from companies that have a great idea and think they could just go out and raise $50 million because they have a great idea. And if we remember back to the dot-com days, investors are not looking for build it and they will come. We need to make sure they've already built it and they're on a trajectory, not only in revenue, but growth of business that makes sense. When I say growth of business, that doesn't mean that I did 500,000 year one and I did $1 million year two. That's not a compelling growth story. A compelling growth story is they did $1 million and now they're on track to do 4 or 5 million or upwards. And the reason is they've proven that what they have, the market wants. And that's what we look for, is to find them in that growth curve, rather than think, well, if only had the money, I could get to that growth curve.
They want you want them to demonstrate that they're on their way. And now the next part of this process is going to be that IPO, and to get them to trade at the public markets.
So let's just expand on the public market strategy. So typically there are phases of funding. Typically the first round is what we call friends and family or angel money. Then you get into your Series A, which might be a smaller offering, and then companies have the option of then looking for the next round of funding. And typically venture capitalists or private equity firms step in and offer those types of funding. The frustrations that we're finding with our clients or people that want to work with us is that when they go to the private equity and venture capital, their methodology is to take board seats and also have clawbacks. And that's kind of interesting, Kenny, because the more sophisticated people you talk to, whether they be private equity, venture capitalists, bankers, they'll all say the same thing. We've yet to see a company hit their projections. So what the PEs and the VCs do is they say to the company, we love what you have, we'll give you the money at a lower valuation. we'll take less equity up front. But if you don't hit your projections,
Right.
year after year, not just the first year, we get more equity.
Right.
And the end result is that that private equity or that venture capital firm ends up ending with the majority position.
Right.
And they typically squeeze out the founder.
Right.
And they miss the big liquidity event.
Right. The founder misses the big liquidity event.
Correct.
Right. And I think that's exactly the key.
You need to focus on the aftermarket.
Right.
And so where you start determines where you end up.
Right.
You start in the basement, it's a long climb up the stairs.
Right.
If you start in the right place, listing on the NYSE or listing at Nasdaq, you started in the right place, and now you have to focus on, number one, bringing the right type of investor,
Correct.
which we refer to as the sticky investors,
Right. So
institutional investors.
I was just going to say, define that, right? Because people don't necessarily understand what a sticky investor
Right.
is, and it's exactly that, the institutional investor versus somebody who just wants to trade it, get in, out, someone who's not sticky, right? You want long-term investors who are committed to the idea, committed to the stock, and want to see the company and the stock do better. Okay, plus, when it was born out of the Obama Jobs Act, right? I mean, it sounds like a great idea. In fact,
yeah.
maybe in the end it will be a really great idea, but I still think it needs some time, right? Needs some time to mature and grow. But one way or the other, you guys, you know all about Reg A Plus, fine. You also know about the IPO process, even better. And so, you know, this whole conversation today really talks about helping these companies generate the ability to bring them to the public market in an IPO process.
So if I could try to simplify it a little
Go
bit.
right ahead.
So I think a lot of CEOs think that if they do what we call a micro cap IPO,
Right.
that they don't get the kind of support they need. Well, if it's done right, and in our research we have found companies that have gone public in the micro small cap arena
Right.
that have 70% institutional ownership.
Right.
They have high volume of trading.
Right.
You don't see the peaks and valleys of an illiquid stock where you get a bounce and then a drop.
Right.
You see a steady growth curve. And when CEOs understand, if you do an IPO the right way,
Right.
and you have the right investors in the beginning,
It's to their benefit.
then it's to their benefit that they're not going to end up with a penny stock.
Correct.
Our goal is to create a new currency for our clients, having a public stock that has value.
That's right.
And the only way you create value is to have the trading volume and the consistency in the way the stock trades. You can then use that stock to do acquisitions.
Right.
So it allows you to help grow the business.
But it's also important, institutional ownership, and then we'll tie this up. Institutional ownership is also very important. It's important not only to that public company, but it's important to other institutional investors that are looking, who's
Yes.
involved, who's in this, because that's all public information, so you can see
Right.
the institutional ownership.
Exactly.
So, one way or the other, listen, thank you very much for coming to New York Stock Exchange and explaining this, and it was really my pleasure.
I
It's
just
always
wanted
good
to
seeing
add,
you.
Kenny, that I don't think a lot of CEOs understand or realize that institutional investors are the mutual funds.
That's correct.
They have in their charter the ability to buy into a small micro cap.
Right?
The issue is that when you get a banker who's not focused on getting those type of investors,
Right.
they're more of the retail focused, you're going to end up with a stock that's illiquid.
Right, but
'cause
those are the non-sticky. Those are the non-sticky
non-sticky.
investors, and that's not what you want.
From my experience being a CEO of public companies as well as an investment banker, I see what CEOs go through and the struggles they have in this process.
Right.
And so it's helpful for us to be able to share our knowledge.
Yeah, and it adds another level of credibility to who you are, who your business is, what your business is, and what you do, and what you bring to the table.
And you mentioned how we do our business. It's an important aspect. So we have gone through 30 companies to find one that we thought had the right ingredients.
The right mix.
Which is great management.
Right.
In this case, great management and great product services.
Sure.
And they have all the ingredients ready to go to a public market.
Right.
We are a shop that looks at doing quality and not quantity.
Right.
And so we've spent over the past 3 years going through 30 companies to find one that we thought had the right mix that could get to the finish line and be a company that would be successful, most importantly in the aftermarket.
Right.
So we've been very particular about who we work with for that reason.
But I think that's important, right? Because you just said it. You don't necessarily want to be out there representing anyone, because if it's not the right fit, it's not the right fit. Not only for you, but for them as well.
Right. Exactly.
And so, the public markets are a great place. And, as you noted, I've been here for 38 years in the greatest marketplace in the world. And so, I encourage what you do. And I think it's great.